All right, buddy, today we're going to be talking about how to handle highly appreciated stock and what are some things you can do to mitigate the taxes on that stock there. Now, we have 9 ways that you're going to be able to do this. Those last couple we're going to go over are going to be pretty unique, some stuff that you probably haven't heard before. So make sure you stay tuned to the very end here, and we'll go over all these different strategies that you can do around taxes and your highly appreciated stock. Now, first and foremost, first we're going to go over here is donate to charity. Okay, so if you don't need this stock and you think, I'm going to give it to charity this year, and if you don't give all the money to charity, right, maybe you give some money to your church, right, every year. Maybe you have a charity you give to anyway, and you currently are using cash. So you might have some money in your checking account where every year you're giving that money to charity. Well, instead of using the cash, another idea, you could use the highly appreciated stock that you have instead. And by doing that, you're not paying taxes on that stock. So you can keep the cash for yourself. That's not taxable for you. But then the stock that you have, whether it's going to a church or any kind of charity organization, they're not going to pay taxes on that highly appreciated stock. That's one way that you can do it, right? Kind of interchanging funds, right? If you're giving to charity. Now, if you're not giving to charity, this won't help you too much. But if you are, it's one way to do it. Now, some of you might say, well, Al, listen, I don't want to give 100 grand to charity right now. But maybe you want to over your lifetime. And a lot of people who like tithe today, they give the church, they might give $5,000, $10,000 a year to their church. Okay. Well, that's not $100,000. Let's say they have 100 grand in stock that they want to give to the church. They don't want to give them all right away. They kind of want to keep this money and give over time. There's a way to do that too, while still getting the tax deduction today. And how you could actually do that is with a donor-advised fund. How that works is you put money in this fund, could be highly appreciated stock, it could be cash. You put it in here, and you get the tax break in that year. But you don't have to give it to charity that year. You could actually invest this money in the stock market, right, for example, and it'll grow tax-free inside of there. So if you put $100,000 in here, it'll grow tax-free, and you could take it out every single year, wherever you want to do with it, and give it to the charity of your choice. So kind of unique in this way, where we're actually able to take money, give it to charity, get a big tax break. For those who like Roth conversions, this could be a good strategy if you want to convert a lot of money in 1 year. You can use the tax deduction you get from the DAF to actually convert more money to Roth, from your IRA account. We have some other videos on that. If you want to check out our channel, definitely can look at those below. A ton of videos on Roth conversions and how that works there. But you can use your stock to help with that. So with DAF, another interesting way. Those are the first 2 things right around charity. But there's other things too. Let's say you plan on giving this stock to your kids down the line anyway. Or maybe they're paying for their college, all right, maybe you're doing something along the lines where you're gonna give your kids money. Well, instead of giving them cash, which, right, doesn't really help you from a tax standpoint, you can give them highly appreciated stock. Now, why might you do this? Well, if your kids are in a lower tax bracket than you, maybe they're in their 20s, right? Maybe you're giving them a wedding gift, all right? Maybe it's helping them with their first house, whatever it might be. I'm saying if you are going to do this, you can give them your stock. You can gift it to them. Now, when they sell that stock, they might be in a lower tax bracket than you are right now. Now, we didn't talk about tax brackets with capital gains yet, but there's 3 brackets. There's 0, 15, and 20. You might be in this 15 or 20% bracket for capital gains. Your kids could be in the 0, all right, which that means you're not paying any taxes on this stock here. Again, maybe be careful in how we plan this out, but instead of you paying 15%, let's say you're giving $50,000 to your kids for a wedding or for a house or whatever it may be, it's kind of your gift to them, money you're going to give to them anyway at some point down the line. If you sold this stock and there was a $50,000 gain in there, now you're going to pay $7,500 in taxes. Where if your kids got that stock and they sold it in the 0% bracket, you're not going to pay those taxes anymore. All right, so pretty powerful tool here in gifting to the family and how that works. Now, the other one is wait for retirement. So if you have stock today, instead of trading it in and out, you could wait until you're maybe in a lower tax bracket later on. And again, with these brackets that we have here, right now, if you're a married couple, under $96,000, we're in the 0% tax bracket. That's going to go up every single year with inflation. So if you feel like when you get to retirement, you might be in a lower income, well, you can sell the stock then. And if you do that, you're not going to pay any taxes on that stock. Or if you sold it now while you're working, you might be paying this 15 or 20%. So strategically knowing when you might sell something could help you in the tax side of stuff when it comes to this. And one big thing here too, we mentioned, doing conversions. So let's say you plan on converting your money over to Roth and you take money out of the Roth that's tax-free, doesn't count as income, well then it's a lot easier to get into the 0% bracket down the line. So a lot of our clients that we do is we actually help them get into the 0% tax bracket, and then we can use their other taxable assets, like their stocks or remaining IRAs, because now we're in a much lower tax bracket at that point in time, maybe the 0% bracket, right, where they can now sell this stuff and be tax-free. Now, we got another one here. Hold until death. So again, if you don't need the stock and it's just sitting there, and maybe you're like, geez, I might want to give this to my kids or family, whatever it may be, if you hold it until your death, there's something called a step-up in cost basis. How that works, if let's say you have a stock that's worth $100 when you bought it, and now it's worth $500, right? You hit big, right? You got a really nice stock there, and you don't want to sell it yet. So what you could do, you pass away, let's say it's worth $500 the day that you pass away, the new cost basis for your kids who inherit this is going to be $500. So if they sell it at $500, they're going to pay $0 in taxes. Now if it grew and went up to $550, they didn't sell it right away, they'll pay that $50 they'll pay capital gains on, but still a giant tax savings that they got there by doing that. So holding until death is also an option that you have there, something you can kind of utilize. Next, what if you actually want to use this money today? Now, kind of another charitable thing here, but charity has a lot to do with tax savings. You could exchange money into a CRUT. It's a trust, a charitable remainder trust. And how this works, let's say we have $1 million in stock that has appreciated, right? And $1 million capital gain here. If we were to sell all this stock at once, what's going to end up happening is you're going to end up having a 20% capital gain. Because anything over $500,000 in income plus your capital gain is going to be a 20% tax on that. So that could be an issue. If you move stuff over into a CRUT, you can do this with real estate too, okay? So this works for real estate as well. You can move the stock to a CRUT, sell it inside of there, and then reinvest it in other things. You're not going to pay taxes on it. Because inside this CRUT, if you sell it inside of here, it's growing tax deferred. You're not going to pay taxes while it's in the CRUT. And what you could do is you can say, hey, over the next 20 years, I'm going to take this money out of the CRUT. So there's a whole calculation that you have to do. You can do up to 20 years. You can do less if you want to take it out in 10 years or 15 years. But the whole point is it gets you into these lower brackets. And $1 million is probably the minimum you want to do this with. If it's more, that works even better. But let's say we got 50 grand a year out of our $1 million. And that 50 grand is putting us below that threshold of the tax, where now we're paying 0% tax on this, as opposed to paying 15 or 20. And now we're getting the money every single year. Now with a charitable remainder trust, there is an amount of this that does go to charity. So keep that in mind, right? The remaining amount after these 20 years taking money out of here does go to charity. So if that's not something you want to do, this probably doesn't make sense for you. But typically the tax savings that you get will make up like what you give to charity. You're basically giving charity a portion of your tax savings that you receive here. So it's an idea, something that you could use within here. Now we got borrow against capital, right? Kind of an interesting one here. So if you have a stock today, and again, like $1 million, maybe $2 million in stocks, and very appreciated, and you want to buy maybe a piece of property or invest in a business or buy something else, you could borrow against the stocks. All right, so you actually say, hey, and you're not going to borrow the whole thing. Typically, 30 to 50% is like a normal amount you could borrow off a stock portfolio. Sometimes more, depends how much money you have, but and what stock you're into. So they look at these margins. But you could borrow, let's say you borrow $300,000, all right, off the portfolio. You're not going to pay taxes on that $300,000. You're still holding the stock. It's just a loan. It's like refinancing your house, all right? You're getting a loan. There's no taxes on that. The con of this, though, you're going to pay interest, all right? So there is the interest. And rates are a little bit higher today, so you're going to pay a pretty large amount of interest on here. But again, if that interest outweighs the taxes that you're going to pay, or maybe the future appreciation of the stock, it can make sense. All right, but then there's another option that you have with highly appreciated stock today. And the last one, this one's kind of interesting, called a swap fund. And these aren't available to everybody. You have to be an accredited investor in order to do these. But how it works, let's say someone, we'll do a random stock out there, someone owns $2 million in Google. Okay. All right, so we have Google stock, all right, Alphabet stock, and we want to diversify. That's a large part of your portfolio, and you're like, geez, you know what? I'd like to own some different stocks, but I have some big capital gain on this. I don't want to sell it. That's where a swap fund comes into play. Basically what happens here is that you're going to give this $2 million, let's say you want to give the whole $2 million, to a swap fund. And they're not going to sell the stock. They're going to add it to their portfolio. And there's other people just like you, but hold different stocks. Maybe there's an Apple, there's Microsoft, there's different companies, Amazon, that are all out there that all add their stocks to this swap fund. And now you will all own a part of this fund. You don't pay any taxes on it when it goes in there right away. You'll own a part of this fund, and then essentially you'll get growth off of all the stocks now. So you're diversified. Now a portion of this, about 20% of it, has to go into real estate to make this work, essentially. So they have some real estate funds they buy into as well within there. Now returns might not be as high as your current stock, but now you're diversified within there. So if you're a little worried about diversification and you want to get some money off the table but not pay taxes on it, a swap fund could be a valuable thing that you can utilize there. So hopefully that was helpful. That was a couple things that we went over. A lot of stuff you can do in terms of appreciation of stock and all this stuff here. But ultimately, I think there's probably a solution here that might work for you. Probably not all 9. All right, but hopefully 1 or 2 of these make sense. It's something you could utilize in your portfolio going forward. Now, if you haven't liked or subscribed to our video below, definitely do so. A lot of great videos on our channel. Check us out, and we'll see you next time.